Okay, Assalamu alaikum everyone. My name is Wasim Sayed and I'm going to do this presentation regarding dollar cost averaging. So let me see if I can mute everyone because I don't see that button anymore.
You don't have to mute anybody. I think everybody's mute already.
Oh, okay.
Everybody understand very good
Okay.
to Zoom. So I think we can continue and then
Okay.
everybody knows. So
So let me start. Yeah, so dollar cost averaging, let's move the slide. So dollar cost averaging is basically, I will be using the acronym DCA in this presentation, and I'm defining it in one sentence below. So dollar cost averaging DCA is time in the market and not timing the market. So this is what the idea is today. Nowadays, it's very famous that everything is becoming autonomous driving, autonomous flying. So this is basically automated autonomous investing. And after 20, 25 years in market and learning the hard way, I have come up to a conclusion saying that for an average investor or a user uh, who who wants to invest in stock market, the easiest and safest way is like dollar cost averaging. That's what I am uh, coming to a conclusion here. So let's talk about it first. Let's go through this disclaimer, which is very important. The information presented here is for educational purposes only. Past performance does not guarantee future results. No investment strategy is 100% safe, so you should be consider your risk tolerance before beginning investing, trading in stocks. Only invest from your discretionary income, which is not used for your living expenses. I'm not a financial advisor registered with FINRA or SEC. Seek independent financial advice from a licensed advisor before employing any of this or any investment strategy, actually. Ideas presented are from my personal experience and online research and are not from any accredited financial institution. So it's a mixture of my research and my experience. So that's what this is. Once the disclaimer is done, let's move on. What is dollar cost averaging? Let me explain in more detail. Dollar cost averaging is a strategy where an investor regularly invests a fixed amount of money at regular intervals, regardless of market conditions. So whether market goes up or down, you are constantly in the market, you are investing, and you want to be in the market and gain the benefits. And this is what we are going to emphasize and discuss further. The key concept here is to focus on the disciplined approach of investing consistently over time, which can be beneficial for various reasons. So let's see, is time in the market better or timing the market better? So let's discuss that. Is time in the market better? Importance of time in the market. Dollar cost averaging is one of the ways to be in the market. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high, averaging out the cost per share over time. Reducing risk. This approach helps mitigate the impact of short-term market fluctuations, lowering the overall risk of the investment. Compounding effect. It has compounding effect. Over time, consistent investments can lead to the compounding effect where your returns generate additional returns, enhancing long-term growth. And this is where I have come in and designed an Excel sheet or Google sheet. I've done a lot of back tests to see in different periods and different equities, different kind of ETFs, what the results are there, and they are astonishing. So that's why I was thinking that it's my responsibility now to share in my community with my family and friends, especially the youngsters, so they can start doing the um, early start in this investment world and reap the benefits of this. So now, impact of market volatility on DSA. Let's see. So Time in the market, importance of timing in the market, we have discussed. Compounding effect, we have discussed. Now let's come to impact of market volatility. Actually, the market volatility helps in dollar cost averaging. And since the market never goes up in a straight line, using dollar cost averaging, you accumulate more shares due to market volatility because you are buying at a constant pace with a constant dollar value. Hence, you accumulate more. So in this example here, we are showing that you had $6,000 to invest. You chose to buy all at once, or you are buying, distributing it in few months. So if you buy 600 shares, let's say at a certain date, and it was all purchased once, then you will have 600 shares. But let's see in the next 6 months, market moves like that, like the chart, the way it is showing. In the second month, you bought 77. The month after that, the market went down. It's 167 shares. And at the end of the 6 months, you acquired 678 shares, which means for the same investment amount, you may have gotten more shares because it lowers your market risk by averaging the pricing out. So this is one benefit of having dollar cost averaging. The second benefit, impact of market volatility, again, we will discuss from a different angle. After a drop in market price, you recover faster and become profitable, even if the price comes back to the same price as when you started investing. So lump sum investment, $8,000. In this example, we are saying you had $8,000 and you bought all of them together. Then you had zero return after certain months when the market came back to $10. So it's one of the equities and we bought it and it was $10. It went to 14 and then it went to $7.50 and it came back to 10. So you had no return because you just recovered, recouped your money back. But if you were doing dollar cost averaging during the same time, your average cost will become $9.61 and your return is 4.07% in the same period with the same price. So this is another advantage, and it gives you some safety also, saying that if the market continuously moving down, you're accumulating more shares. So now let's talk about timing the market. Timing the market is good for people who want to get involved, and my friend Sabri will be talking about that. But in this case, because we are focusing on people who are either they don't have much time to spend in researching things, or they don't know the technical and fundamental analysis. So this is the reason in this presentation we are focusing that timing the market for those people is not such a good idea. Why? Disadvantages of the timing of the market is market timing is challenging because predicting market movements accurately is sometimes difficult. Most of the times it's difficult, and I have some research I've done on it, and there is some detail there. Even for seasoned investors, trying to time the market can lead to missing out on potential gains or entering the market at unfavorable times. So you could be entering an emotional bias. There is emotional bias also, and it has happened to me several times in the past 20 years that I was thinking the market should be going one way and the market went the other way. I took my decision, had to take losses and get out. So market timing decisions may be influenced by emotions like fear and greed, leading to irrational investment choices. Trading costs. Frequent buying, if you're paying commission, frequent buying and selling all the time can result in higher transaction fees. But if you know what you are doing, like our friend Sabri is going to explain, then you can obviously multiply the results better. But in this case, for a person who just want to automate their investment, I was looking for the easiest way to do so and still be participating in the market growth the way it is for last 100 years, 200 years. We are seeing US market and global market. So reducing trading cost reduces the overall returns. Missed opportunities. Attempting to time the market can result in missed opportunities for long-term growth, as it's challenging to consistently predict market movements. If you're wrong one time, it can take away a lot of profits. Let's see what the gurus are saying on the internet. Since there are only a few days in a year, that bring the highest returns, missing those days can impact overall returns severely. And this is what they are showing. S&P 500 from 1990 to 2019, you can see even missing one best day reduces your return. And then if, for example, you missed 15 best days, it became 1/4. So what they're saying here is missing only a few days of strong returns can drastically impact overall performance. And that's what I'm showing here based on the research they have done. Here, I think I will just skip this video. I was thinking that we will run this video which explains DCA further, but I have now added some questions and answers and some slides in here which elaborates how it does. So at the end of the session, I will allow 10-15 minutes for people to be able to ask their questions. So, and at that time, maybe we can run this video. So conclusion, it's a short presentation, not too much discussion here, but in conclusion, dollar cost averaging emphasizes the importance of consistency and discipline, allowing investors to benefit from the potential of long-term growth and minimizing the risk associated with market timing. By focusing on time in the market rather than timing the market, investors can, not regular investors who do 9-to-5 jobs, can improve their chances of achieving their financial goals. So now I'm going to say that not everything is perfect. This is not that easy, but it is. But let's see what the challenges are for a person who's starting to come into the stock market or coming into investment. And people in Canada and USA, I think they are, if they are working full-time job and are in a certain tax bracket, they are forced or they are pushed to come into the investing world anyways due to the tax advantages which are offered. Outside North America, I'm not sure what the benefits like are for regular people to get in, but there are tax benefits here, especially investing in your self-directed retirement plan and a self-directed children education plan in Canada. So, but nothing is perfect. Let's analyze the challenges of doing DCA and how to overcome those. So these are like few questions which came to my mind, and I tried to answer them in one sentence in later slides. So let's talk about it. Challenges of doing DCA. First challenge, when to start, which market to select, which stocks to select, how many to select, how much amount to invest, how often to invest, how to reduce purchasing costs, how to utilize every penny I have available to invest, how to avoid drawdowns. And this is a more elaborative subject, so I'm going to only answer if there is a question on it. When to get out, that's another question. So these are, to answer these, let's come to the next slide. Overcoming techniques. When to start? As early in life as possible. I wish I knew this 20 years ago. I would definitely be retired. By investing very little amount, you can accumulate due to compounding effect, and overall market always moves up. So you would be accumulating wealth. Which market to select? If that is the question, my preferred market is the US market, because it's so large and there is liquidity and diversity available there. And all the back tests I have done, spending hours and hours, I have done in that market, because I have seen Canadian market is more commodity based, and that's why its performance cannot match a well-diversified big market. So that's my answer to that. Which stocks to select? This is a very preferential thing, but still, I would recommend to go with ETFs, because these were not available 10-15 years ago, 20 years ago, especially the ones where they are multiplying their speed by adding some factors to it. So, but the thing is, it's all your choice. You can go with Apple, you can go with any stock you like, or you can diversify. So high quality growth stocks, like Warren Buffett selects, you can choose those and see, and you can even have combination of stocks so that you are not putting all your eggs in one basket. But these ETFs, they have already done that. For those who don't know, QQQ is the NASDAQ 100 where there are top 100 technology and biotech companies are put together, and they are all in that index. If a company does not perform, they kick them out. So you don't need to worry about that. And then they have introduced in 2006 this QLD, they call it, which is like double the speed, and then TQQ, which is 3 times the speed. But let's see what my back tests have shown the results on different ETFs or stocks. How much amount to invest? It all depends on your time horizon. If you have longer time horizon, like in retirement savings plan or education savings plan, you just got baby and you want to invest somewhere. I did for my kids with someone like a mutual fund advisor, and after 10 years we were not nowhere, like we didn't even move, like 6% or 8% we were. That's also triggered me to find a better way to help people out so that they can invest a small amount but gain good chunk of money when the kids go to school. You may start with a little, as much as $100 a month or just $25 a week, and the tests we have done are based on that. How many to select? Now, for diversity, I will recommend, if you want to go with stocks, select at least 5 different sectors, the stocks from 5 different sectors, so that you do not, it seems like not everybody is muted. So 5 different sectors, and I've just listed few sectors by market cap, not recommending that you should go by these. They change by market cap, but I'm just listing here for people to know what sector means. Computer sector, telecom, transportation, aerospace and defense, insurance, retail, utility. Now, I personally avoid insurance and bank stocks, but that's my preference. I usually am in technology stocks more. So next is overcoming technique number 6, how often to invest. My back tests have revealed that the results are not too far apart if you give this technique or dollar cost averaging 10 years in the market. And most of us in 50s, late 50s, I think we have 8 to 10 years. So if we want to get in, we are not too late still. Every 10 years, this technique will produce positive results, and I've tested it for last 50 years, and it seems like that's the case. If you give 10 years, 10 to 15 years, you are ahead. You will make and you will beat the common mutual funds and things like that. At least once every 6 months, if you put money in, you are good in my back test. Ideally, what I have done, I want my investment to be in my investment account and invested automatically every paycheck. So in North America, usually it's a bi-weekly pay periods. So automatically it deducts some money from my account and puts it into the investment account. That's what I prefer. This also reduces the drawdown or take advantage of all the small movements even in the market. So this is my test result. I've just picked up one ETF, which is the NASDAQ 100. So it eliminates the worry of selecting stocks and finding what works, what doesn't work, because there are companies who I have seen have gone bankrupt. Nortel, Air Canada went bankrupt. I lost all my money. GM even claimed bankruptcy and came back. So these are the problems we can face selecting or going with one stock. But look at the power here. And I'm trying to show here that investing in different frequencies does not make much difference. And this is after a lot of work I've put in. So you can see that if you do every 5 days, $25, the total amount in 11 years was only $15,000. But due to the market, the portfolio value was $219,000, which is almost like 1,400% or something like that, or 2,000% basically. So 10 days, 15 days, 20 days, all of the tests I've done, the only time the return has dropped is when you only invested once a year. And this is what I was doing every year for last 20 years when nobody has told me what to do. I was just doing the investment at the time of taxes to gain some tax advantage, not focusing on this part of the equation. Because at the time of tax, if you have contributed in the previous year in your RRSP, you get some of the tax back.
Wasim, sorry to interrupt you. Is this triple Q or QLD? You said NASDAQ 100, but this is QLD.
Yeah, NASDAQ 100 double.
It's QLD, it's double, right? Double leverage.
Yeah, so I have the back test of QQQ also. So next is overcoming technique, how to reduce purchasing costs. Nowadays, before there was lots of commission, but there are brokerage houses and you can contact your different companies like I'm using in Canada, Wealthsimple, who's allowing zero commission purchases. There are pros and cons, but in the long run, I think it's not a big deal, but go with 0% commission if you can. The next is how to utilize every penny. And I have noticed in my back test, if we go with a broker who's allowing fractional buying, that utilizes the last penny you have. And that has added into compounding. So if you can go with a broker who's allowing you to do fractional buying, that will really help you utilize every penny you have to invest. And this setup is basically auto setup. I can help people out to do that setup if they're looking for. How to avoid drawdown. This is a more involved subject, and I think that's where comes some of the knowledge of the technicals and overall market situation, which we can talk on in another session. The last one is when to get out. And it is all dependent on your goals. So for example, if it is RRSP and you are continuously working, then you should get out at retirement and reap the full benefit of this technique. If it is RESP, obviously people have kids going to university at 18 years of age or 16, 17, whichever, then you can start withdrawing. You don't need to collapse the entire thing, just take out yearly expenses and then you can let it continue. If invested in TFSA, which is a tax-free savings account in Canada, I don't know which one is corresponding to this in US, but you can accumulate tax-free wealth and utilize it to buy a house, pay a down payment, car, or anything, or when the kids get married. So these are the different timings you can exit out of this strategy. Now, this is the chart where I have. The reason I have started this from March 11 because TQQ was not available before that, and that's where my focus was at one time to see. This is the yellow highlighted one is showing QQQ, QLD, TQQ. But now you can see that NVIDIA has beaten. But at the time, 10 years ago, you didn't know if NVIDIA is going to become this NVIDIA. So it's impossible to invest in a stock which you don't know whether it's going to go up or not down. For example, some of my friends are in Ford. If you would be doing this investment in Ford, it only went up by 200% in 11 years. Maybe it's good for certain people, but if there are more different things available, you should be going. And you can even combine these to have a portfolio, as I said, with 5 or 3 or whatever number of stocks and set up all of them to be automatically invested. So I've done these multiple tests and it's only showing 5 days, but let me show in the next chart. So how important this chart is showing how important it is to start early. And you can see these are like unbelievable kind of numbers with AMD and NVIDIA and Amazon, and Tesla is not even here because it was not available in 2010. I took only companies which were available. So Apple, Microsoft, they have all done fantastic, 600, 700, 800%. But these ETFs have done better than those. How powerful DCA is, this is also it's showing and allowing huge returns with very small amount invested. For example, in QLD, $15,200 total accumulated doing at any frequency has returned almost 1446%, which is 40% plus compounding every year. Which investment gives? No one. I think in Toronto they are saying it's bubble, but that real estate, I don't know if that has even given like 15% or so compounding for last 10 years. How important it is to remain in the market, it also shows that, as you can see, and how safe it is to be in an ETF versus a stock. Like it is very safe because you can predict that it is going to move. It's not going to vanish. These are like billions and billions of dollars in SPY and QQQ there are. So many companies are using those. So how profitable it is to stick to the US stock market, that's also it's showing. if I would show you results from Canadian market, they are not that big unless you were lucky and you were part of a stock which has gone hyperbolic. So this is what it is. The chart I'm showing here for QQQ, you can see how your invested amount was and how your portfolio has done. And obviously, from peak to turf, this is called drawdown. And if you are using investment which is double the speed, then the drawdown will be double too. But in long run, it takes out, maybe this was bigger than this, but now it's showing here because it's in the chart. So you can see that we have almost recovered back from that drop, but when you were buying, you must have accumulated more shares. And now when the market actually, if it comes a little bit up, you will be ahead of the game again from 2021. So this is where I end, and any questions I can answer, and then we will take it from there. Can we unmute people, please? Sabri?
Yeah, I'm unmuted.
Okay. Is
No.
there any questions here?
Assalamualaikum, Wasim. Can you hear me?
Waalaikumsalam.
Please unmute.
Can you hear me, Wasim?
Yes, I can.
Yeah, this is Mubashir. How are you doing?
Yes, Mubashir. How are you? Good, good.
Alhamdulillah, alhamdulillah. No, first of all, I really want to congratulate very thorough analysis.
Thank you.
And I am thoroughly impressed with the detail or the background you have. And I enjoyed, and I sent the link to my two sons also.
Yeah, I
So-
wanted youngsters to come in.
Especially with the dollar cost averaging, I think it's really important, as you emphasize, that the sooner, the earlier you start,
Yeah, the
the
better.
more benefits you're going to see over the long run.
Yeah, yeah.
Yeah, so no, I truly appreciate. I had a list of questions before you started, but you did such a thorough job that you covered all the questions I had.
Good.
So-
Okay. Thank you very much,
No, It
Mubashir.
was amazing, Basim. Thank you so much.
Thank you. Thank you.
So Wasim, question. Hello, Masood here.
Yes, Masood.
The question here is TQQQ right now is around $41. Am I right? So it is, I think, 52 weeks high. So
Yeah.
and I think 52 weeks low was around 16. So
Yeah.
that's not the good time to buy TQQ right now.
No, okay, Masood, this triple leverage thing, we have to discuss this because yes, the results are really good, but the thing is the drawdown is really high also. So you cannot, and actually you cannot even compare it where it is now. You have to see the QQQ. Because the way this is designed, they have designed it to be moving 3 times every
Yeah.
single day. So every single day they have to match the price of this ETF to QQQ by 3 times. So if QQQ moves 1%, this should move 3. If QQQ goes down 2%, it should go down 6. So that's how it is. And in the up markets, this is much, much better. But in downturns, it can draw down really large amount of money from your portfolio. But if you have tolerance, and if you are only investing a certain portion of your portfolio, maybe 20%, then maybe this result will balance out. So in one of my friends and my brother, I have explained to them saying, maybe a balanced approach would be to go with certain percentage of these things in your portfolio and let it run automated. But the thing is, like, if there is a huge drawdown, if there is a drop in market, like COVID came, then obviously you will be accumulating a lot at $16. But the thing is, the rest of the money will be coming down too. So to answer your question, the amount where the price where TQQ is, do not look at that, look at QQQ. So if QQQ has not passed any major highs, it has not made any highs, you are good to go. Like the TQQ can go to 80, 100, 200, 500. I have seen SOXL, which is a semiconductor ETF. I have seen it at $700 from $17. in
Yeah.
2019 and 20, I guess. But then it went down. So they are also constantly forward and reverse splitting. That's why I said that this topic is quite involved. This triple leverage thing, we can have a separate session for those who are interested in double leverage and triple leverage ETFs. But the thing is, for now, if we stick to single leverage, like non-leveraged and stocks, that would be good enough. Or you can have a combination, have TQQ certain percent, QLD certain, and QQQ, and then you are good.
Well, again, the question, then you can have for the hedging, you can buy the inverse, the bear,
Yeah,
S triple
definitely,
Q.
definitely. That's another topic. Yeah, that's another. And this is
That-
what all I'm researching to make it easiest as possible for people. But the thing
that-
is, sometimes the reverse also hurts you because the natural tendency of the stock market is to go up. So if you are not familiar with that, and if you think that inverse ETFs can give you profit, I will show you charts where you will see that they are all destroyed because of this up market in last few years. So you have to be very careful if you get into that. It almost brings you back to day trading. But the idea here is for youngsters to get involved early with very small amount, put that money into certain equity, certain ETF, and reap the benefit of this compounding effect of the market. As you can see, AMD and Nvidia and Apple, like all these have, Amazon almost 1,000%, Tesla must be more. So you can do any of those. Okay.
Yeah, understand. But I did little research on this, the biotech ETFs, LABU and LABD.
Yeah.
And the combination of these two, really making me in benefit and profitable always, no?
For last 2 years, LABU has been crushed. It has destroyed a lot of portfolios where they were, because LABU never did not move. And there are certain market conditions where biotech moves. If biotech did not move, it was destroyed, because the danger in triple leverage ETF is if the market goes sideways, they start losing their values. It may be sounding like bizarre to you, but in the back test, this has shown that if the market is only going sideways, triple leverage ETF will be going down. So with the dollar cost averaging, you are covering some of that problem, but still, I think if somebody wants to go with one ETF, it's QLD, I would say, where it is covering both. It is eliminating the need of constantly researching the stocks. It is also not keeping you behind, that after 10 years, you see other stocks have gone thousands of percent and you are only 400%. So it eliminates that factor. Plus, it gives you ease of mind that easily you are leaving it to professionals who are kicking the companies out who are not performing. So even if like the stocks may vanish from the face of this earth, but these ETFs will remain there because they are constantly being monitored. So I was doing this seminar actually in 2006. I've been teaching people. I was helping based on a software which I was using, and on Saturdays I used to do this. So there are people who can verify that they retired just by buying QLD, not even dollar cost averaging, but other ways they were buying. One teacher has sent me an email saying, I retired in 5 years after 2008 when I was accumulating QLD. So it's a powerful tool, and we have to find ways how to utilize these things properly. This is NASDAQ. Then there is SPY, which is covering all S&P 500. So if you don't like your portfolio moving up and down too much, then you can stick to index and do the dollar cost average, which you will find hundreds of videos on YouTube. But what I have done in this entire thing is to allow you to see what the power of this thing is. Let me actually share my sheet, which I have created to show what work has gone into this. I'll not take more than 5 minutes more, Sabri. Let me just show that so that people see what is involved in this work. So let me share my screen again. This is screen, which is my this one. So you can see that I have created a lot of formulas and done a lot of work on this this thing. Why is this not going up? So you put the do you see my screen?
No machine.
No, no,
Oh, okay. So let's see. Okay.
Not
So
now,
do you
yeah.
see it now?
Yeah.
Okay.
Yes.
So what I have done here is you can plug in equity or ETF, and then you can tell the frequency you want to use, and it calculates based on live price from Google Finance and does all the math and tells you how much your portfolio value would be, how much drawdown it will be. And this is where I have selected all of them. So you can see 5-day frequency has produced that result. 10-day frequency has produced this very similar. 15 days have produced that. So I have all other tabs where you can see, even by going different number of days, like you only want to invest in 25 days or 30 days, the results have not changed until and unless you go to once a year only. So you can see here, if you would do once a year, although the drawdown will be very little, but the thing is, this could be a major loss if you are not investing on a regular basis. So ideally, I would say 15 days bi-weekly. That's what I have set up with Wealthsimple. Automatically, it as soon as my paycheck deposits a certain amount, maybe $100 or $50, go out to this, and then it buys in fractions. So you can buy 1.6 stock, 2 stocks, whatever the price is, and then it puts it into your investment portfolio. So that's what this sheet does. And I've put a lot of time in making sure that it is speaking the live data. So there is no hanky-panky, there is no guesswork. You can go back in charts or any brokerage and check the prices of this thing, whether it was there or not. Even though I was using a software in VectorVest, they were not offering this back testing. So I did this. And here also I have, if you had all the money up front, then obviously the results would be way huge, much higher, but not everyone has all the money up front 20 years ago. So that's why this strategy has been created. Okay, so I'll just take off my sharing.
Yeah, that's a good strategy, I believe, for like slow and steady wins the race.
Or you can put certain percentage of your nest egg in here. You don't need to play with Labu and LabD with 100% of your money which you need at retirement. I will never recommend that. It will just be disaster, because now again you're trying to time the market, and without good knowledge and luck, you will not be able to succeed in that. So I would recommend that for a person who wants to be hands off and run this on an automatic investment plan, like my son is, my cousins are, and they have young kids who are just born. I love to see them putting some money aside for this, because I was not informed about this, and we had to pay from our pocket to cover few of the expenses for my son's education. So this is the reason I'm doing this. So you are right, Waqar. If you are in a mode of monitoring it constantly, and maybe you're doing it full time, then yes, you should time and you should look for the best. Still, I would not recommend Labu LabD. I would say you should, if you are doing day trading type stuff, go with SOXL or something, or TQQ, which is more stable with large cap stocks in it.
Yes, you're right, 100% right.
Yeah.
So, Wasim, another question is this Wealthsimple is free?
Yeah, Wealthsimple is a new company. I'm not advertising. I'm not getting anything from them. I'm just letting you know that this is the only software I found in Canada which has allowed me to do this automation. So now it takes the money in Canadian dollar, it converts to US. They make money there, I guess, but I don't care. They make some pennies there, and then they buy the ETF, and then I'm done. So I just get a message, your money came to the account, it got converted, and by the end of the day, the same day, they purchase whatever each penny can buy. So sometimes they buy 2 stocks, 5 stocks, 2.6, 2.9. So I'm happy because this back test I've done here is showing that fractional buying would be much, much more beneficial because you will not have any money sitting, even dollars, in your account uninvested. And then there is an option there you can turn on which says reinvest my dividend. So that's another thing. All these ETFs, they give dividend also because of the companies giving dividend, and that dividend gets reinvested whenever it comes in. So it's totally basically automated, but it needs time. You cannot come in the January of 2022 and you say that, oh, at the end of 2022, my portfolio is down 18%. Yeah, market went down 36%. So with dollar cost averaging, you were able to accumulate more, but your drawdown, which we call from the high to low, was not that much. So having said that, it's already 11:45, and I don't want to take any more time from my friend Sabri. If there is any question, you guys know where I am. I have invited you all using my WhatsApp. You can always reach me out, especially let your youngsters do this so that they can get into the market as early as possible. Okay.
So well simple is safe, but they are making money in conversion only.
Yeah, I think so. They are. And plus, yeah, and maybe they do whatever they do, like it's Robin Hood and others.
Yeah.
Okay. Thank you, Mubashir. Thank you, everyone. So people can stay for the next session we have with